All right, welcome, welcome. I'm going to share the impact investing course here. Philip, you can't have a question yet. We haven't said anything. I appreciate the enthusiasm, though, just to see what your actual question is. Welcome everyone that's starting to log on. Would love to hear where you're coming from. So if you want to do an introduction in the chat, you can put your name, where you're dialing in from, and what your interest in the webinar today is. That would be great. Always so good to see people we've interacted with before, who have been on other courses. Always fun to have alumni. So and starting out with alumni and fun friends. Hello, Barbara. Hello, Karen. Carol and how nice to see you both. I'm glad you can be here. And Philip. And we have more people trickling in as well. So I'll just give it one more minute, and then we will do introductions and start off. All right. I think. What do you think, Tash? Should we get started?
Let's get started.
Excellent. Okay. So today we are talking about, oh, go back. Precious, go back. Today we are talking about incentives for driving impact in deals and in funds. Very pleased to have my colleague Natasha with me here from the Bertha Center, as well as some friends that are along to talk about their experiences. Sagar, who is going to talk about a deal at Grey Matters Capital, and Mark, who's going to talk about his experience at Emergence with the Green Outcomes Fund. And I'll go ahead and kick off my piece as well. It's okay, Precious, I'll take over on the screen. And just to note that all of the content that we're talking about today is a preview of what will be on the Impact Investing online course, which the sign up for that, the deadline is on Friday. And we have an incredible lineup of speakers and of participants that will be joining us on that course, and we can talk more about that as we go. My name is Ani, and I'm the course convener for the Impact Investing in Africa program, as well as I'm an advisor to the Bertha Center, and have been working on how to integrate impact into investment deals and funds for about 10 years now. So I'm going to give you a quick overview of the way that I think about how we can put impact into deals and funds. And then I'm going to hand over to Sagar to talk about a deal that he did and how he integrated impact into it. I'm going to take over here. Here we go, starting out with the Impact Investing in Africa course live. There we go. All right. So there's a few different ways. Oh, and please do continue to introduce yourself on the chat. Feel free to ask questions in the Q&A or on the chat. We will be taking them at the end as well as throughout the talks today. So this is part of the Innovative Financing Toolkit that we spend quite a bit of time in the course and in other courses that we teach here at UCT on impact investment and innovative finance. And so we'll just start with deal terms. So there's a few different options that you have when you're thinking about wanting to integrate impact into deal terms. Now, you have to ask yourself a few questions before you start to do this, which is around the outcomes that you're trying to achieve with the specific impact investing deal. You need to also ask yourself who needs to be incentivized in order to achieve these outcomes. So is it the entrepreneur? Is it the fund manager? Is it end users? And then is there a financial trade-off for these impacts? So there are different ways to integrate impact into deals. Some will require a trade-off. So for instance, from an outcomes perspective, if you're trying to incentivize a company to serve a more rural population or a poorer population, as a funder, you might need to subsidize that because it might actually be costlier for that company. And so by integrating that impact, you might have to have a trade-off. In other circumstances, when you're trying to get companies to scale their impact or to grow, they might actually be aligned with impact. And so you might actually not need to take a financial trade-off to be able to incentivize them. And if you do have to take a financial trade-off, the question you have to ask is who's willing to bear that cost? So there's three different ways that I think about integrating impact into deals. One is when capital is allocated, and this is around something we call tranching. So you can decide to put actual milestones within deals that say that the capital will not be allocated until the specific social milestones are met. So you might do 100,000 Rand or dollars into a company, but only 50,000 of it up front and 50,000 of it once they had hit a specific milestone, such as the number of women impacted by the program, the number of farmers, the amount of increase in specific farmers' livelihoods, et cetera, et cetera. Another is around how ownership is calculated. And there's two different options that you can think about here. One is something called vesting, which is where entrepreneurs actually earn back the shares of equity that they own. This is something that is done in most early stage deals and normally is linked to financial milestones. So what happens is that a funder invests money into an early stage company and says to the shareholders, the owners of the company, we're actually going to take your shares and put them into another bucket and you'll earn them back over time. And this is done so that early stage funders, when they get money, don't just walk away from their company. This can also be done with social milestones. So you can also think about saying to founders, your ownership in the company can actually be earned back over time based off of hitting social milestones. Now, this is also the case with equity when you're doing it from a purchased equity perspective. And Sagar is going to talk a little bit about that in his deal. But what some investors are starting to do is actually to invest in a company to say that they are going to purchase a certain amount of equity, but then allow the entrepreneurs to essentially earn that equity back from them based off of social milestones. Now, another option is how much capital costs. This can be made in the form of payments, so outcome payments, or something we call an interest rate rebate, which means that if an entrepreneur achieves specific social milestones, then the cost of their loan decreases, or in something we call a margin step down, which means that the return to an equity holder will decrease, or in an outcome payment, which might be made by a third party. Which is something that we're going to talk about as well with the GOF. So that's some of the ways in which we can think about integrating impact into deals. We can integrate it into when the capital is allocated, into how ownership is calculated, and also into how much the capital costs. Now, when we're thinking about integrating it from a fund perspective, we want to ask these same questions. In the case of funds, we often might be in the situation where we need to incentivize the fund managers to create additional impact, not just the underlying entrepreneurs. And so there's three different ways we can think about this. So one is impact carry. And this is essentially carry is how fund managers earn their compensation. So we can link carry, performance compensation, to impact as opposed to just financial milestones. And this is something that, to be honest, I've been talking about for years and years and has been, lots of people have been talking about for years and has not been part of the impact investing industry, but is slowly starting to catch on now. Another way to do it is outcome payments, which Natasha and Mark are going to talk about with the Green Outcomes Fund, is to pay fund managers to create more impact. And by pay them, we mean into the fund to create outcome payments. And then another one is to do something called an impact tranche. This is where, as a funder, you put money into a fund, into a separate part of the fund, to say that you would like your capital to be directed specifically towards more high impact organizations, potentially riskier organizations, etc. So 3 different ways to think about it from a fund perspective: incentivizing the managers with impact carry, creating outcome payments that actually go into the fund, with Natasha and Mark are going to talk about, and then thinking about creating specific tranches for funders to be able to do higher risk, higher impact deals. All right, and that is where I am going to stop. I know that was a quick whistle-stop tour. Hopefully everyone was able to do it. I'm going to hand over to Sagar, and he's going to talk through an impact equity deal. And I will and hopefully you'll have lots of questions at the end for all of us. Sagar, thanks so much for joining us from Indonesia, staying up late tonight to come and join us. Appreciate it.
No problem. I share the same passion about using innovative finance to integrate impact, how Oni has been trying to do with her work. And I'll share one example. I'll share my screen. 1 second. Okay. So here I will talk about one example that, can you guys see my screen? Just want to make sure.
Yeah. Yep, all good.
Yeah. So one example that I did during Grey Matters Capital was around impact equity. And before that, I jump on why we even thought about impact equity was we were signing an agreement with an entrepreneur. And the problem which came into the picture was we were sure that the entrepreneur has intentionality, can actually reach to the mass market and low-income population, but we still have some doubts. And we thought to bring accountability, how actually we can do it. So we actually did a very simple thing. And also because Grey Matters Capital, at Grey Matters Capital Foundation, we had our own LP money, which was coming from one pot. So we were able to take some kind of a risk to structure it and probably have some financial hit also if it is required. So what basically we did was we divided the equity into 2 halves. So one is impact equity and financial equity. Just to give an example, what happened was, so we were supposed to take 10% equity in a company. And we decided, why don't we put 1% as an impact equity and 9% as financial equity? So what it actually means is, basically this impact equity is an earned back equity for an entrepreneur. So certain period of time we defined 5 years period. If you achieve these certain outcomes that we define in the term sheet, then we will give you back this 1%. Honestly, we didn't say that 1%, rather we say that 10% of our equity position during that time, when the conversion is actually happening or the exit is happening. That's the way we felt. There are 2 layers of incentive for the entrepreneur, is to create impact as well as get something back when they create that impact, because we also felt we need to financially incentivize some of these entrepreneurs to actually do that. But while doing that, we also understood, which I'll just leave you guys here with, around how we are being incentivized or disincentivized for the entrepreneur to create impact or not. And we realized that we as fund manager also, we need to attach our impact as well with our investors. And I think Oni brought this specific term around, can you do impact incentive at the fund level? And that's what recently I have started exploring in my new avatar, is incentivize the entrepreneur, but also incentivize and disincentivize the fund manager. So we now attach impact carry. I won't go still deeper into that, but yeah, so that's a quick example that we did. The example was in a situation where we were doing gender lens investing, and we defined some gender lens outcomes that you need to reach these many girls by in next 5 years. And if you do that, we'll give you back your impact equity.
Sagar, can you tell us at all how it worked out? Has the equity been earned back?
Yes. No. So we still need to know. So we have done the deal in 2018, 2019.
Okay.
The entrepreneur is on the track as far as I am now in touch with the entrepreneur, and potentially he will be able to reach. I'll say some of the problems that we were not able to deal really well with was how to define some outcomes upfront. And
Yep.
honestly speaking, rather than defining outcomes, we ended up defining a lot of outputs, which I
Yep.
won't say is the best way, but we were trying to experiment it. Is there a way to incentivize entrepreneurs to achieve some output that we want? Like, okay, you want to go towards giving education to girls and boys, but we want at least you cover 51% or 50% of girls, so that you create a gender neutral product. That's what our focus was. And I think the entrepreneur is well above 50%. So I think in 5 years, he has a target to achieve, and potentially he'll achieve that.
But I think that's a really good point, Sagar. And I think we talk a lot about outcomes when we talk about this, and the Green Outcomes Fund, which Tasha is going to talk about. But in reality, what I've seen, from my work collecting, I've been collecting these, as you know, term sheets of embedded impact contracts from around the world. It is majority outputs. And I don't necessarily, I don't think that's that bad of a thing. Actually, Natasha and I were speaking about this recently, because, for the duration of these contracts, really an output, something that's a bit easier to measure than an outcome may actually be the right thing to put in these contracts. If and there was you are sure. Yeah, go ahead.
Yeah. No, there was actually a reason why not to go for complicated outcomes. Because structurally, Grey Matters Capital is finance first impact fund. So we still look for good amount of returns, and we go for market-based returns. So we cannot have a financial hit by bringing in the third party evaluator to evaluate it. So we want such a simple system which we can track it on an MIS system. So well-defined, crystal clear outputs that an entrepreneur don't feel pain to track it. We don't feel pain to verify it easily, honestly. So more we were thinking like an investor.
It makes total sense, Sagar, and that's a great example. Thank you so much for that. I'm sure people are going to have questions from what you've presented. Tash, do you want to pop up? You're going to talk about the Green Outcomes Fund, which you have been essential in setting up, and you can tell us a little bit about why it was set up and what it looks like now. I will hand it over to you.
Fantastic, thanks, Arnie. So the Green Outcomes Fund, as you will have seen from Arnie's slides, we have been working in the innovative finance space at the Bertha Center for coming close to a decade, and the Green Outcomes Fund was really an opportunity for us to take some of the theory that we speak about all the time and put it into practice. And so we're very excited to have launched the fund. Very excited to have Mark join me today. So Mark is one of the fund managers that we've partnered with on the Green Outcomes Fund. And so I'm going to talk you through a little bit of the process of how we got to this fund. So what we know, and everybody knows this, is that small businesses have a fantastic impact on society. They create jobs, they develop communities, they have an economic impact. But green SMEs take that one step further by also having a positive effect on the environment. And so there are very high impact segments of the market, but incredibly underserved, particularly in South Africa in terms of accessing finance. And so what we did, we worked through a design thinking process as we were developing the Green Outcomes Fund. We went to investors, local fund managers, and sought to understand why this access to finance challenge existed when it came to green small businesses. And we spoke to a number of investors who all gave us very, very realistic reasons as to why these investments were not happening organically. So a lot of these green small businesses are very innovative, they're new, they're early stage, they haven't been tested before. Their founders are often from technical backgrounds and are first-time entrepreneurs. They don't have a background in business. And there's a lot of risks and costs involved in this investment. That's not to say that it's not a viable investment, but it is one that is going to require additional either risk appetite from the investor perspective or additional costs to be incurred in terms of business development or getting in consultants to assess the bio-waste sector. And so we realized that there was this challenge there. And on the other side of the market, there's donors. We've got grant funding coming in that's looking to catalyze really big impact at scale, and particularly looking for both social and environmental impact. And donors are looking for ways to use their funds responsibly and efficiently, whereas usually what happens when donors provide funding is that the funding is provided up front, the project is implemented, and then it is reported back on how much impact was created. And so this setup really spoke well to the idea of outcomes-based funding. And so the Green Outcomes Fund was designed to incentivize and support these investors, these local fund managers, to increase their investments in green SMEs. And it does so by paying for green outcomes, such as green job creation, climate mitigation, and improved water and waste management. And we can talk more about those. So on the one hand, it's working with the investors to overcome those risks and costs that they've identified by providing them these outcomes payments. And on the other hand, it's allowing donors to really be efficient and effective with the use of their funds to not only pay for outcomes after they're achieved, but also to catalyze investment from the private sector as well. So very quickly, I'm going to walk you through exactly what this looks like. This is a great concept, but how does it work in practice? So the very first thing that happens is the investors, and we're going to chat to Mark shortly about what this looks like from the investor perspective. But the very first thing that happens is that an investor makes an initial investment into a green small business. And this is an investment that otherwise, without the Green Outcomes Fund, wouldn't have happened. So it's a deal that probably would have gone to the investment committee, and would have been, the investment committee would have looked at it and said, viable potential there, but just a little bit too risky, or there's more costs involved in this than we're comfortable with. But the investor makes the investment because of what is about to come next. So the second thing that happens is that the green business produces green outcomes. And this happens organically as a result of ordinary business operations. Because these green businesses are inherently green, as part of their day-to-day business operations, they create green outcomes. So there's no extra effort there. Those green outcomes are then reported to the investors, who report it to us as the Green Outcomes Fund, who then report it to the donors. And we've got a very rigorous monitoring and evaluation and verification process involved in that. As soon as you are tying payment to outcomes, you want to make sure that those outcomes have been achieved. And so we've got a monitoring and evaluation process in place that assures that. That then goes to the donors that we work with. We're very fortunate to be working with both public and private sector. The Jobs Fund is our main funder for the Green Outcomes Fund pilot, and the First Round Foundation is one of our supporters as well. So the outcomes go to the donors. The donors then release outcomes payments based on those green outcomes created, and outcomes payments are then released to investors, who are able to use these payments to offset some of the risks and the costs that are associated with doing these deals. And I'm going to hand over to Mark now to talk about in practice how this has impacted the way that Mergence, where Mark is our Bertha Center friend and GOF partner, has been involved. Mark, can I hand over to you?
Yeah, thank you. Good afternoon, everybody. I think this is a very interesting topic. Um, it's been a long journey since how we managed to get here. Um, so I'll just provide a little bit of context in terms of practically as to how it works and what journey I've been on over the last 12 years in the impact investing space. I think when we started off, we launched a high impact credit fund. And that credit fund was basically just to invest into subsectors that's aligned to our national development plan addressing some social and or environmental issues. And we were purely purely focused on sector, not really looking at impact measurement at that stage. But the market is changing, and we embrace change. And I think what Oni has termed embedded impact, we were thinking of impact 2.0, and then looking at output versus outcomes, and been on the journey of discovery. We're in uncharted territory at this point in time. But if I bring it back to from a practical point of view, we've got we manage pension fund money, which is mainly limited partners in either private equity funds or open pooled vehicles. Our role, we see our role as just as a fund manager in terms of directing capital into places where it's needed the most, where it can give the best return to our clients, and also deliver an impact at the same time. And we can't do this without obviously people and teams. And various different parties are those three different stakeholders in the value chain. And obviously the other part being the actual target company in terms of the outcome and delivery there. There's either financial or non-financial incentive or reward driving a certain behavior or motivation. Now, in the credit funds, historically, it's been very difficult for us to use innovation in terms of trying to motivate or deter target companies in terms of doing something or not. And what we've seen in the credit space, obviously, what we've managed to achieve is just to ensure that portfolio companies continue to do what they've been doing historically. Whether you're lending into, whether you're investing into educational financing, please continue to do that. And our purpose of our funding is only to do that, nothing else, not to cover working capital, etc., but to make sure that the funding gets to the end beneficiaries and to mitigate the leakage in the system. Switching to private equity funds or infrastructure equity funds, there we've got a lot more tool sets that we can actually use to actually make a difference. And I'll try and bring in this to whether the GOF actually assists us in this. But yeah, it's important that we find alignment across all the different stakeholders from the start. Now, I spoke about the limited partner, the general partner, the investment manager, the team that's in that investment management company, and then also the portfolio to the target company. So there should be an incentive reward for all the different parties, and we should try and build an alignment structure that rewards on the upside and penalizes on the downside. And what we're seeing the new generation of funds going forward is this concept of an impact committee sitting alongside or being a subcommittee of the investment committee, where that committee is also being set targets, and they've also monitored and evaluated almost similar to what a normal traditional investment committee is being tasked to do in terms of looking at risk and return. That committee is also looking at impact return and impact risk. And I think that's quite a unique innovation. And then there's rewards for outperformance and penalty for underperformance. And that stretches across both the house and the investment team. So coming back to GOF, so how we got involved in the Green Outcomes Fund was, we've invested like about 562 megawatts of renewable energy. We always knew that commercial industrial sector is really where the high impact component really is in terms of potential for job creation and also the potential for levels of abatement of greenhouse gases, especially from South African context. So commercial, industrial, and residential. But our problem was that our minimum investment size was 50 million rand. And we also don't invest in early stage businesses. And also, we normally pass on the impact measurement to target companies. And then also, we still want to give our clients a good rate of return above the benchmark. And this subsegment of the market is somewhat different to there's a bit of a disconnect. On the one side, we're looking for that. The market is over here. And the Green Outcomes Fund basically builds a bridge for us. And how does the fund actually do that? It assists us firstly in terms of focus and technical assistance in terms of looking at the subsegment of the overall, let's say, energy market, both in terms of evaluation and monitoring. Then, in addition, as to what Natasha mentioned earlier, is that if we do perform in terms of achieving those outcomes over and above our normal investment return from the portfolio company, we enhance our return potentially, which can then be used in the unlikely event of underperformance to cross-subsidize those underperformance matters or cases. And then similarly, in those specific transactions where it's possible, we can also then pass on that incentive to our target companies, either by, if we're doing a loan, a rate reduction, if we're doing an equity transaction, it's either a call option that can be exercised by the target company, or let's say a put option for underperformance that we can exercise in the event of underperformance. So that ensures that in the board meeting, in the management pack, impacts on the agenda, as opposed to it just being an afterthought. So you've got alignment all the way from the LP all the way down to the target company, and then also the workforce and people being responsible for it. So how has it changed? As I mentioned, this alignment is an important concept. It's being put into practice now. LPs are expecting the impact to be evaluated in the deal screening process, the due diligence process, and they want evidence in terms of that being in the transaction terms. And then secondly, monitoring and evaluation of impact and reporting of that back to limited partners are very, very important now. So in summary, we had a challenge. We needed a solution as a fund manager. We couldn't do it ourselves. We needed an institutions like Bertha developing a Green Outcomes Fund together with National Treasury and other donors to assist us in terms of putting our round ball into the square box. And we're now looking at some opportunities in the space that we would not have looked at before, either because of size, stage of investment, or in terms of the transaction cost potentially being too high to actually look into these subsectors, and returns then obviously being negatively impacted by that. So all in all, a great product, great solution, and we're looking forward to seeing the future of this partnership coming together. Thanks, Wani.
Excellent. Thanks so much, Mark. Thanks, Tosh. Thanks, Sagar. You guys can pop your videos back on if you'd like. No, Mark, don't go away. Come back. There we go. All right, excellent. So I think that was a quick whistle-stop tour, but a really good example of some of the ways in which we can think about integrating. So Mark spoke about kind of going from that LP, from the limited partner, down to the GP, down to the deal level. And then Sagar talked about, actually at that deal level and then going back up to the GP level. So I think the fact of the matter is that I think one of my things I believe, I know Sagar and Mark and Tash do too, is that, you know, unless we start integrating these metrics into how we are incentivized, you know, things just aren't going to change. And I think both Mark and Sagar talked about wanting to do, you know, these types of deals and being able to use impact metrics. So we've got a couple of questions we'll go through. You guys have been very quiet on the chat, so please, I know many of you that are here, so I know you have questions, so please give us some hard questions. I'll start off with a couple of them that are here. The first one that I really liked, and I think we can all probably talk about this, cost benefits, legal costs in setting up impact targets, and how to deal with it in a way that doesn't get too complicated. So anonymous attendee, whoever you are, it's a really good question. And I think that I think we'll all have opinions on this. My just first opinion would be, you know, make sure that some of the things that Sagar said, so make sure that you're already collecting the data, that it's easy for you to be able to capture that and to report on it, that it aligns with what, you know, the data that the business needs. And then also, you know, going back to this outputs versus outcome. Oh, it's Bilal. All right, thanks, Bilal. To this outcomes versus outcomes is, you know, making these decisions. If you're, one of the things that I always say, having done innovative finance for a decade, is sometimes you just have to isolate the innovation. So we want to do everything. So we want to make a new contract with a new type of impact and a new type of incentive and a new type of enterprise. And so one of the things that I can suggest is sometimes simplifying and making sure that you can test out different pieces. So if you're trying a new type of contract, you know, try and make it simple. If you're trying a new type of incentive, you know, try and make it relatively simple so that you can test out to see whether or not that works. Saga, Mark, do you have thoughts on that?
Just quickly add on the legal cost one. So structurally, we did convertible note. So it was easy to define as like how the conversion happens on the debt that has been returned to the investor. Here we said, if the impact has been returned or has been created, the equity will be converted to this formula. And we remove that impact equity piece. So then structurally, we are not making any new change. There's no taxation, nothing. We just use convertible note to do that.
Interesting. That's cool. Thank you, Saga. Mark?
Yeah, I think it's an interesting question, important question. I think, you know, especially given the size of some of these opportunities, the transaction costs might just erode all the economic benefit, you know, that's potentially present for both parties. And so I think on our side, obviously, the more you standardize terms, etc., it's easy to replicate and to spread the transaction costs across a number of different transactions and make some just minor changes where possible. And I think, yeah, very important is to make sure that monitoring and evaluation subset is easy to execute and cost effective. Otherwise, you also stand the risk there of not necessarily the legal cost, like, you know, eroding the value, but, you know, the actual implementation, execution of that being quite value destructive.
Totally great. Tash, did you want to weigh in on based off of all of the work that you've done on setting up the fund, the golf? I know you guys made a lot of choices.
And it wasn't easy. And I think that that one of the things we've learned is that the more we do these kind of deals, the easier it's going to get. And working with when we spoke to partners and players in the market who had exposure to similar kind of deals, that's when the conversation started moving a lot more quickly. So that's one of the things we want to do with this, is that the more we do it, the more we can do more of these kind of things and help other people set them up and make that process so much smoother.
Yeah, I think it really often just comes down to like having access to templates and to resources. I mean, so right now I'm writing a book on alternative early stage structures, and there's a whole section on these idea of embedded impact contracts. And so, you know, creating resources for people to be able to just take the terms down. There's some great resources out there already, such as the Impact Terms Project from Tonic is really useful. But yeah, we need more resources. We need better resources, and we need more lawyers and intermediaries that understand how to do this so that it doesn't take 10 hours of legal work to figure out whether or not, something actually can work in a specific jurisdiction. Yeah, Isagar, did you have something else there?
Yeah, I'll just add what you just said before. Keep things simple and maybe isolate few issues that you want to resolve. Keep simple as like outputs. If you don't complicate it, I think there are some easy ways to do it also.
And if you are going to complicate it, I mean, when we started setting up the GOF, which, as Rowan said, right, as Rowan started 4 years ago and was incredibly complex, make sure that you've got the right partners, make sure that you've, got the funding to do it, and see in some ways some of the work, right, that the team has done and that we did at the very beginning too, that was some of the public good in itself. And so, one of the things that I've seen that has evolved in this space, 10 years ago when we were looking for funding to create these innovative financing instruments, there was no funding to actually create the instrument. And there's more now, there's more funders that understand that some of the public good is actually some of the work around the standardization and some of the work to actually make it easier to replicate. Okay, another question from Nathan. How are impact returns benchmarked? Wow, Nathan, you're going way in the future. We're still like baby steps. You're like, how do we run a marathon? Like, where's the marathon ending? God, I don't have any, right now I have no good answers to this.
Yeah, it's like where you want the world to be like in next 5 or 10 years. Because I've done very early stage investments, seriously. We don't know most of the times. Is the intention that we know that the business can do it, and can we parameterize some of those intentions and say, okay, reach these many people, do this way, and that's it. So I have a very different outlook on this as an early stage investor.
Mark?
Yeah, so I think a key component for us, especially the Green Outcomes Fund, has got 2 components to it. Two buckets of components. So the one being job creation, and the second one being, outcomes abatement matters. So with regard to jobs, which is obviously very imperative, very key in a South African context, given a high unemployment rate, and also the nature of jobs being created, not, a lot of top level jobs, but, low skilled, semi-skilled, and jobs within the youth sector, trying to invest into labor absorbing businesses, which Natasha correctly mentioned earlier, is the potential that's embedded within these green SMEs. And so how do we, if it's an engine that's got the ability to absorb a lot of jobs, how do we put more? So then the question is, if we have, in our minds, if we have our last rand or our last dollar, and we're looking at 2 opportunities, give the same financial return, but what is the number of jobs being created per million rand? And we'd obviously invest into the one that's giving us a higher number of jobs per million rand. Now, coming back to LPs, so certain LPs have that lens in their hand as well. They're looking at it and say, well, and even if you approach them in terms of committing to your fund, they would hold you to account and say, well, you said you're going to create 3 or 4 jobs per million rand. And that will be penciled into your investment management agreement, your partnership agreement. And you need to make sure that everything that you do down the line jump over that benchmark. So how do you get to that benchmark? It's actually, well, firstly, the internal benchmark is basically a promise that is made to the LP to come on board. So how did you get to making that promise is that you had to go back and look at the subsector and study it, do research on it. And so that's the size of the market. If we put 50 SMEs to focus on that market successfully and sustainably, each one being able to absorb 10 people, or you got 500 jobs there. And how much capital do you need to deploy to those ones to get them moving? And so the market is changing. The game is changing to how we used to play it. LPs are expecting a back, coming back to the benchmarking exercise. LPs are expecting, they're doing their own benchmarking across different managers. So spoke to X, Y, and Z. They said they can do 10 jobs per million rand. You say you can do 5. Can't you do better? And so that information is also being collated now, and it's becoming quite interesting. So benchmarks are being developed as we go along.
Excellent. Perfect. Tash, sorry, did you have something to add there?
Yeah, I think it's so interesting because the benchmarks are being developed, but at the same time, I think as much as we'd like a clear-cut formula for this, it's so much more nuanced than that. So jobs is just one metric, and even if we look at jobs, what sort of quality jobs are we talking about? Are those jobs low-skilled jobs or high-skilled jobs? Where in the country are they? And so it's so very difficult to be able to benchmark any kind of, even just one metric. And so I think one of the things we learned in designing the GOT is that as much as we'd like a formula and as much as everyone else would like us to have a formula that we can share, it really is about engagement around that and open discussion and getting to a point where we do have comparability, but understanding that a lot of the time we just won't.
And I think that's so important, Tasha. I think what we've seen in the impact bonds and other outcome-based contracts is that the only way you can start to get to internal measures, so Mark, as you said, you can go through and you can do these external kind of market measures. The only way you can get to kind of internal benchmarked measures is by doing repeated auctions, in essence. That's how we do price discovery, and that's how we're going to do impact discovery, if that's a thing, which, maybe I just coined that too. I do like coining terms. So, that's how we're going to get there, is by trying the same things. And that's what we've started to see with some of the social impact bonds, where for instance, like the UK government was able to issue ones over and over again, and then they were able to see, how to benchmark some of these outcomes. And I think that's something hopefully we'll be able to do. So we've got a bunch of questions on here about cost. So really quickly, guys, 2 cents on how we reduce the cost of impact measurement. I'll go with my first 2 cents, which is digitize it. So you've got really cool firms like 60 Decibels that are using cell phone surveys, that are other firms that are starting to use things like remote sensing. If we're able to digitize this to be able to make it cheaper, easier, and less hands-on often, even though it can still be qualitative, we can still be asking people questions, but just in a much simpler way, we will bring the cost down. And also having off-the-shelf ways of doing that, which is important. So not having to create a bespoke measurement system every single time. I think using things like IRIS and like the Impact Management Project and some of the stuff 60 Decibels and others are creating is ways to standardize it, digitize it, and make it cheaper. That's my 2 cents. Guys?
Oh, I think I resonate with you. Yep.
Mark?
Yeah, I agree with you, Oni. I think obviously the reduction of the costs. It's if the transaction is big, that component of the cost becomes relatively small. And the question is who's going to carry that, who's incentivized for that. So the question can be who splits it. So on large transactions, I don't think it's like a material issue. If you get it into smaller sizes, it becomes quite difficult. And then also, I think if the manager can carry it, and it's spread across a number of different counterparties, it also reduces it. Yeah. And then also, obviously, the other innovations that the manager can actually put in place to actually do that. Because now he's incentivized to reduce that cost himself, because if he does,
he or she, Mark, he or she.
So yeah, he or she. So then he or she can come up with solutions to actually address that. Yeah,
I completely agree. Tash?
Yeah, I think we were very fortunate to work with partners who were very supportive of the fact that, verification is so critical when you're doing a structure like this. But I think that one of the great things is that the more we do it, the easier and cheaper it'll get. And essentially what we want to do here is kind of create a, for lack of a better term, economies of scale here. We managed to set up one system that works with multiple of our investor partners, and hopefully we can set up a system that then can be replicated. And the more we do it, the easier it'll get, the more routine it will become, the more it will be built into due diligence processes and reporting of SMEs into systems. And so it is a little bit of a learning by doing process, but I feel quite confident that the more we do it, the cheaper it'll become.
Excellent. So there's an interesting.
I'll add just
sorry, go ahead.
I just had a very small, quick thing is there is a cost involved, but there is also one more thing is involved is the time involvement of the entrepreneur side, specifically when it's a small team and small projects that they are working on. How much time you should take away from them? Honestly speaking, I feel like what Oni has said around digitization, we need to attract more and more people to track it rather than ask them to go away from it. Probably as an industry, we need to have better, easy solutions which are easily trackable, just like how you do accounting. You need to have impact accounting.
Yeah, but I also think, Sagar, it needs to be aligned right with the data that you're collecting anyway. So it's like if it's really useful data for your business, then the entrepreneur is also incentivized to do that in a way that's easy and cost effective.
Yep.
So we've got an interesting comment here from Bhavanesh, who said that the normalization will help if financial institutions report and impact components of their lending book, which is an interesting idea. We're starting to see this with some climate change pieces. Yeah, Saga, go ahead.
So this is something very interesting. I was just typing my answer also for Bhavanesh. Is around the lending component, because I have spent a lot of time understanding fintech, and in my previous avatar, even I was trying to start my own fintech venture. And one thing that I continuously see, I'll just draw one parallel. So in student lending, a lot of people now talk about income share agreement. Can we actually do the same thing for productive loans which are given by MFIs or MFIs to MSMEs? So rather than just give loans at fixed interest rate, can you actually attach that loan to a revenue share? So you are giving a productive loan to a small micro enterprise. They should improve their productivity and increase their income, and you should attach to that so that incentive is aligned for giving loans to an MSME so that they improve their productivity rather than you just put them in a viscous circle. I think that probably is not even, you need to think something very radically different, but you make that debt a variable debt attached to the income of that small micro enterprise. Specifically in the loan books, I think that nobody is talking about. I have been thinking for a very long time why revenue share in debt style for microfinance cannot happen. Maybe I think somebody should come up.
I think so. There's a lot, and there's some really interesting stuff around revenue-based financing as well. So I think that's an interesting comment. And then there's two more questions that we'll see if we can get through. So Nikita, good question around the outputs not being achieved due to external forces beyond the control of the entrepreneur. So I'll let Tash and Mark tell us about how the golf does that, but I just would like to highlight some really interesting work that Deborah Barand of NYU has been doing, where she's actually been looking at, this was prior actually to COVID, but she's been looking at what's called a MAC clause, so a material adverse change clause that exists in many contracts and does exist in some outcomes contracts. And so she was looking at what happens when there are big external forces outside of the control of the entrepreneur. And what she's really found is that people go back to, have to be willing, the investors, the funders, the entrepreneurs have to be willing to go back to the table and sit through arbitration to be able to understand what makes sense. And so as I've been interviewing, I've interviewed, almost 100 funders that have done and entrepreneurs that have done these types of contracts that have some sort of impact or revenue share, et cetera. And again, I hear this like setting up a contract that makes sense, but being willing to go back and negotiate if circumstances have significantly changed. And so it's that willingness to go back to the table to find a win-win solution for both the funder and the entrepreneur. Tash, do you want to tell us maybe about how the GOF deals with that?
Yeah, absolutely. So I think one of the things is I agree, Ani, in terms of that approach of keeping the outcomes targets very much a conversation, an ongoing conversation. And so it's not something that's set up at the beginning and then then kind of left to happen. The other thing is that what we've specifically seen with COVID-19 is that the businesses that are involved in the Green Outcomes Fund, because of the fact that it's designed so that these businesses should be creating these positive outcomes as a result of the day-to-day work that they're doing, and that the incentive lies at the investor level. The outcomes that they're aiming for are not going to not happen. They're just going to be delayed. And so for the majority of cases, it's not a case of anyone's getting penalized. It's more a case of that there's a delay in the payment happening. But very much the conversation is open. I think, especially when it comes to something like COVID-19, it's, you know, everybody's figuring this out as they go along. But one of the key elements that I think makes this work is that we're supporting impact that should happen. What we're doing is making sure that at the investor level that we're aligning incentives all the way along the chain.
Excellent, great. Sagar, Mark, anything? I've got one last one for you. I think that you'll enjoy. No. Okay, good. All right, so Jared, you've got a great question here about fiduciary duty. So you've asked about redefining fiduciary duty, which is something that has been happening, but mostly for actually foundations and foundation endowments, as well as there has been some look around government contracts, which we know things obviously like BE, but the foundation endowment side, pension funds and other long-term institutional holders, there have been conversations around that ability to bring other factors in. We obviously know Regulation 28 in South Africa does allow you to, or requires you with no actual teeth in the regulation, to consider environmental, social, and governance issues. And so your question, Jared, does that create a tension or misalignment with the managers of money if you could trade off impact for financial return? It's a super interesting, massive question. I don't think that we're ever going to get to a stage, my own perspective, fortunate over to everyone else, I don't think we're ever going to get to a stage where large pension funds are regularly trading off large amounts of return for social impact, because they have a long-term duty to their pensioners to be able to deliver them returns. But I do think potentially how I see this evolving is that more of the externalities will be priced in, and so the long-term risk analysis will change. And so investing in a coal mine now might look like it will have outsized returns for the next how many ever years, but actually if you do the proper analysis and look at what is going to be the cost of the financial institution over the 30 or 40 years that it's projected, is likely to underperform others. So I think it's not just about I don't think many financial institutions will be able to do much like direct trade-off, but they will change what they actually put into their analysis. Super interested, Mark, I'm super interested to hear what you have to say. One of the first investors in renewable energy in South Africa, you had to make that, I had to make an argument to your board. I remember that was quite an intense argument.
Yeah. So I think, nobody wants to take any trade-offs, and our clients are acutely aware of their fiduciary duty. I think there hasn't been any legal challenges to date in terms of this. We're also very much aware that there is a bit of systemic risk in the sub-segment of the market. And so the trade-off, we've demonstrated to our clients that it's not a trade-off they're making. We're actually putting another lens on the investment strategy to say that actually, if these are massive problems, that they need solutions. The problem's not going to go away. There's certain segments of that problem that can be solved by the private sector. And there's other segments that cannot be solved by the private sector, then the state is left to kind of deal with that. But the piece that can be solved can be a very profitable piece. And also it will address a major challenge and alleviate the pressure on the public's, the fiscus, if that can be the case. I think a case in point, and actually a good example would be like, look at Capitec Bank, one of South Africa's largest banks, started off as a microfinancier, servicing a subsegment of the market that couldn't get financing, and migrated from there. And the investors made remarkable returns of it. massive market, innovative solution, great returns, impact being generated. And I think that's what all this innovation is about. So we're not professing for trade-off, and we're not advocates of getting fiduciaries to step outside their mandated responsibility to their clients to make trade-offs on behalf of other people's life savings.
Although in this case, in the golf's case, right, that you got the best of both worlds. So you don't have to make any trade-offs, and you've got the South African government paying for that.
Exactly.
Excellent. Tosh and Sagar, we are at time. So what's final closing thoughts on that or others?
Sagar, do you want to go ahead?
No, Tash, you go ahead, please.
Great. I think Mark couldn't have said it better. Just thanks very much to everybody for joining us. Thanks, Ani, for leading this. This is a topic I think we don't get the opportunity to talk about enough, and I think there's such a big future in terms of aligning impact with financial incentives, and I really hope that we can see more. If anyone has any further questions about the GOS, please don't hesitate to reach out to me. We're always happy to talk about it and share the lessons that we've learned, and please do stay tuned. We will be sharing lessons as we go. It's very much a pilot, and we're learning, and so we'll be sharing as we do.
Excellent. Sagar?
Yep. Just quickly from my end, I think these kind of conversations we need to have more in this space. The only thing that I will leave with is how we can attract more and more entrepreneurs and more investors, even if they are doing normal venture capital, private equity investment, to actually think about integrating ESG or impact. And we need to make it simple. We need to make it scalable. We need to make it probably potentially zero cost. Just like how we do auditing of financials, we need to do auditing of impact, and we need to incentivize how we incentivize for good customer behavior. We need to incentivize for good impact behavior. And I think there needs to be an impact and financial linkages to that. Otherwise, we won't be able to achieve scale.
Mark?
Yeah, I think my fellow panelists have basically covered everything that I wanted to say. But just want to say thank you to you and the team, Oni, for setting up this webinar. Great fun.
Thanks so much, everyone, for coming, and thanks for our amazing panelists. Just to remind everyone that the conversation continues on the Impact Investing course and in other Bertha Center events, which you will be getting information on. And thank you all for your great questions. I'm sorry we couldn't get to all of them. We tried our best, but really interesting pieces, and we look forward to just continuing the conversation with everyone. So have a good rest of your afternoon.
Correct.
Bye, guys.
Bye-bye.